Picture this. It's a chilly morning in the winter of 1974. You've been up since before sunrise, sitting in a long line of cars that snakes around the block, all waiting for a chance to buy a few gallons of gasoline. The radio is talking about odd-even license plate rules, rationing, and something new in the headlines. A strange word called stagflation. Prices are jumping, jobs feel less secure, and the feeling in the air is simple. People don't trust that tomorrow's dollars will buy very much at all. Fast forward to today. You're not stuck in a gas line, but maybe you've stared at your grocery bill, mortgage quote, or rent increase and thought, wait, I thought inflation was supposed to be under control. Why does everything still feel so expensive? That uneasy feeling, that sense that something isn't lining up between the headlines and your wallet, is what we're going to dig into. Because the ghost of 1970s stagflation isn't just a history lesson, it's a pattern, and pieces of that pattern are quietly showing up again right now. Let's start with what actually made the 1970s so brutal. Before that decade, Americans got used to inflation that averaged around 2 to 3% a year. From 1900 to 1970, the long-run average in the United States was about 2.5%. Then, the 1970s hit, and everything changed. Between 1970 and 1979, inflation averaged about 7% a year, and by the end of the decade it wasn't just high, it was raging, topping 13% in late 1979 and 1980. At the same time, unemployment was awful. After the 1973 and 1975 recession, joblessness in the U.S. hit about 9% in May 1975. And when the Federal Reserve finally slammed on the brakes to kill inflation in the early 1980s, unemployment peaked at 10.8% in 1982, the highest since the Great Depression. High prices and high joblessness together. That poisonous mix is what people mean by stagflation. How did we get there? It wasn't one bad decision, it was a stack of them. In the late 1960s and early 1970s, the U.S. was spending heavily on the Vietnam War and domestic programs at the same time. The Federal Reserve kept money relatively easy, interest rates low enough that borrowing was cheap. On top of that, the whole global system of fixed exchange rates, where the dollar was tied to gold, started to buckle. In 1971, President Richard Nixon cut the dollar's tie to gold, a move sometimes called the Nixon shock, which let the currency slide and set the stage for more inflation. Then came the gut punch, the oil shocks. In October 1973, several Arab oil-producing countries slapped an embargo on nations that backed Israel in the Yom Kippur War. Overnight, something abstract like geopolitics became painfully real at the pump. Between 1973 and 1974, the price of oil roughly quadrupled, from around $3 a barrel to nearly $12. Gasoline prices in the U.S. jumped more than 40% in about a year. You can imagine the ripple effect. Oil isn't just something you pour into your car, it's in transport costs, plastics, chemicals, heating, almost everything. When oil prices shot up, it was like oxygen being sucked out of the economy. Growth slowed, companies cut back, unemployment rose, but prices kept climbing anyway. That's stagflation in real time. The government tried to manage it. Nixon used the Economic Stabilization Act to impose wage and price controls, basically telling businesses and workers what they could and couldn't charge for a period of time. Phase 1 was a 90-day freeze. Later phases tried to guide wages and prices more gently. On paper, it sounded decisive. In reality, it masked pressure instead of releasing it. Shortages appeared, quality fell, and as soon as controls loosened, prices ran even faster to catch up. Just as the economy was trying to recover from the 1973 to 1975 recession, the world was hit with another shock, the 1979 energy crisis. After the Iranian Revolution, global oil supply dropped by around 7% and markets panicked. Oil prices nearly doubled again, rising from about $15 to almost $40 a barrel over roughly a year. Once more, Americans saw lines at gas stations, rationing in some states, and another surge in inflation. By 1979, inflation in the U.S. averaged about 11%. In 1980, it climbed to around 13.5%. Pair that with high unemployment and you get the misery index, inflation plus unemployment, hitting a record around 22% in 1980. People watched their savings melt. A dollar in the bank lost value faster than interest could keep up unless you took on serious risk. The Federal Reserve, led by Paul Volcker starting in 1979, finally decided to crush inflation no matter the cost. The Fed jacked up interest rates to levels that seem almost unbelievable today. The key rates went into the mid to high teens. The prime rate that banks charge their best customers peaked over 21% in December 1980. Mortgage rates hit levels that would make a modern homebuyer's jaw drop. That policy worked in the long run. Inflation eventually fell, but it did it by inducing back-to-back recessions and putting millions out of work. So when people talk about the ghost of 1970s stagflation, they're talking about a nightmare where prices climb, growth stalls, and the cure is almost as painful as the disease. Now, jump to our current decade. After the COVID shock in 2020, central banks and governments around the world opened the fire hose. Interest rates were slashed to near zero, money printing programs ramped up, and trillions in fiscal stimulus checks, loans, and guarantees washed through the system. For a little while, it felt like a miracle. Markets roared back, housing soared, and people talked about a new era where maybe we could just keep the good times going. Then, in 2021 and 2022, the bill arrived. U.S. inflation, which had been close to 1 to 2% in 2020, suddenly spiked. By 2021, it was about 7%. In 2022, it averaged around 8%, the highest readings in 4 decades. Globally, inflation jumped to about 8.8% in 2022, according to the International Monetary Fund. There were lots of triggers: supply chains tangled from lockdowns, massive demand from stimulus, and then Russia's invasion of Ukraine in 2022, which sent energy and food prices higher, especially in Europe. Central banks, including the Federal Reserve, admitted they had been late to react. Once they moved fast, hiking interest rates at the quickest pace since, you guessed it, the early 1980s. By 2023 and 2024, those moves started to bite. Inflation cooled. In the U.S., the 12-month inflation rate slid from about 8% in 2022 to around 4% in 2023 and roughly 3% by the end of 2024, falling further toward the mid-2s in 2025. Global inflation also trended down, with the IMF expecting it to drop toward the mid-3% range by the end of 2025, still above pre-pandemic norms, but no longer in full crisis mode. So if headline inflation is falling, why does it still feel bad? Here's the crucial point. Inflation slowing doesn't mean prices are falling. It just means they're rising more slowly. The level of prices, the numbers you see on rent notices, grocery receipts, and utilities, has ratcheted up and stayed there. Look at the Consumer Price Index, one of the main measures of U.S. inflation. In 2020, the index was around 260. By late 2024, it was over 315, and by 2025, it had climbed further into the 320s. That's roughly a 20% jump in about 4 to 5 years. Even if inflation is now only 2.5 to 3%, your paycheck and savings have to fight against a permanently higher cost baseline. So where does the ghost of the 1970s come in? First, the pattern of shocks. In the 1970s, oil embargoes and political turmoil in the Middle East turned energy into the main transmission belt for inflation. OPEC's control over oil supply meant that when it cut production or imposed an embargo, prices could quadruple in a short time and stay high for years. Today, the world is less dependent on a handful of Middle Eastern producers. OPEC's share of global oil output has dropped from over half in the 1970s to about 1/3 recently, thanks largely to increased production in places like the United States and Brazil. When Israel and Iran clashed in 2025, for example, oil prices briefly spiked but then fell back below pre-conflict levels within weeks, a sign that markets are more resilient than they were in 1973. But that doesn't mean energy shocks are gone. The war in Ukraine has already shown how disruptions in gas and oil can ignite inflation, and new conflicts in the Middle East still threaten to push prices higher, especially for poorer, import-dependent countries. The pattern is familiar. Geopolitics hits energy. Energy hits everything else. Second, the pattern of debt and easy money. In the 1970s, U.S. government debt was surprisingly modest compared to today. During Jimmy Carter's presidency, federal debt hovered around a quarter of GDP. By contrast, in 2024, U.S. gross federal debt had climbed to around 124% of GDP, not far from wartime highs, and projections from the Congressional Budget Office suggest it could keep rising in coming decades. Why does that matter for inflation? Because high debt makes it politically painful to keep interest rates high for long. Every percentage point increase in rates flows through to higher interest costs on that debt. There's a natural temptation, not always stated out loud, to let inflation run a bit higher to quietly erode the real value of that debt over time. That same temptation existed in the 1960s and 70s, and many historians argue it was part of why authorities tolerated rising inflation for too long back then. Today, central banks insist they're committed to bringing inflation all the way back to around 2%. And to be fair, officials like Chicago Fed President Austin Goolsbee have pointed out that we are nowhere near 1970s territory yet. Unemployment is closer to 4%, not 8 or 9, and inflation has fallen back into the low single digits, not the double-digit chaos of that earlier era. But here's where the ghost analogy matters. In the 1970s, inflation didn't start at 13%. It crept up, was brushed off as temporary, then climbed again. What turned a manageable problem into a disaster was a shift in expectations. People began to believe that prices would just keep rising fast. Workers demanded higher wages to keep up. Firms raised prices preemptively, and that feedback loop became a self-fulfilling engine of stagflation. Are we at that stage now? Not yet. Surveys and bond markets still show long-term inflation expectations, mostly in the 2 to 3% range in major economies. But expectations are a fragile thing. This is where your savings come in. If inflation averages, say, 3% instead of 2% for the next decade, that may sound like a small difference. But mathematically, it means your money loses about 26% of its purchasing power over 10 years, instead of around 18%. And if you're sitting in cash or very low yield accounts, the real return, after inflation, could be negative for years at a time, just as it was for many savers in the 1970s. So, is today just a rerun of that decade? Not quite. There are some key differences working in our favor. One, central banks are much more independent and more focused on inflation than they were in the 1970s. Back then, policymakers either believed inflation was a price worth paying for lower unemployment, or they misunderstood how deeply expectations could entrench it. After Volcker's shock treatment, the Fed and other central banks rebuilt their reputations as inflation fighters, and they're very aware that letting inflation stay too high for too long risks repeating that trauma. Two, the structure of the economy has changed. Unionization is lower. Automatic cost of living adjustments in wages are less common, and many prices are now set in globally competitive markets. That makes a classic wage price spiral a bit harder to ignite than in the days when big national unions and large regulated industries dominated. 3. Energy itself is more diversified. Shale oil, renewables, nuclear, and non-OPEC producers mean a single cartel has less control over world supply. Recent conflicts have still moved prices, but they haven't produced the kind of structural years-long shock that the 1973 embargo did. Yet the ghost isn't banished. It just wears a different costume. Instead of relying mainly on oil shocks and wage bargaining, the inflation pressures of our era are increasingly tied to deeper, slower forces. This is where we have to move into clearly labeled speculation, informed guesses about the future, not certainties. First speculative force, deglobalization. For roughly 30 years, companies chased the cheapest labor and production costs across the planet. That just-in-time, ultra-lean global supply web kept prices down. Now, between geopolitical tensions, tariffs, and lessons from the pandemic, Firms are rerouting supply chains closer to home or to friendly countries. That can make systems more resilient, but it's also more expensive. Many economists expect this shift to put mild upward pressure on prices for years. Second speculative force, demographics. Aging populations in rich countries mean fewer workers and higher spending on healthcare and pensions. That can push up wages in tight labor markets and swell government deficits. With government debt already elevated, there's pressure to keep interest costs manageable, which again creates a quiet bias toward slightly higher inflation. Third speculative force, the energy transition. Moving from fossil fuels to cleaner energy is essential for the climate, but the path isn't free. Underinvest in oil and gas while renewables are still scaling up, and you could get periods of tight supply and volatile prices. Overinvest in the wrong technologies, and you eat big capital costs without matching productivity gains. Either way, it's a world where energy prices could swing more than we're used to, feeding into broader inflation. None of these forces guarantee a return to 1970s-style stagflation. But they do suggest that, even if we don't relive double-digit inflation, we may be entering an era where the normal rate of inflation is a bit higher, the global economy grows a bit slower, and central banks are constantly walking a tightrope between controlling prices and avoiding recessions. The ghost isn't a perfect replay. It's a persistent pattern of pressure on your money. So what does that mean for an ordinary person trying to protect their savings? History gives a few broad lessons. Again, this is education, not personal financial advice. In the 1970s, people who held most of their wealth in cash or fixed-rate bonds saw their purchasing power shredded. Someone earning interest at, say, 5% while inflation ran at 10% was losing money in real terms every year. By contrast, assets tied to real things, like certain types of property, businesses that could raise prices, or commodities, often held value better, though they came with their own risks and big swings. Today, with inflation still above zero but interest rates no longer stuck at rock bottom, the mix looks different. Some savings accounts and bonds finally pay something, but after tax and inflation, returns can still be thin. That pushes many savers toward taking more risk in search of higher returns, more stocks, more real estate, more alternative assets. That's not automatically bad, but it can recreate another 1970s pattern, speculative bubbles forming when people are desperate to outrun inflation. The deeper historical lesson is less about any one asset and more about mindset. People in the early 1970s trusted that the system would sort itself out, that inflation was a blip, that their savings were safe just sitting in the bank. By the end of the decade, many realized too late that they had underestimated how fast the value of money could erode. Today, we have more data, more commentary, more charts, but the human psychology is the same. It's very tempting to believe that because inflation has come down from its peak, the danger is over. That was exactly the kind of comfort that lulled policymakers and savers into complacency half a century ago. So maybe the real ghost of the 1970s isn't the gas line or the bell-bottom jeans. It's the habit of ignoring uncomfortable math. The math that says even 3% inflation, compounded year after year, can quietly hollow out savings sitting in low-yield accounts. The math that says high public debt limits how far and how long central banks can lean against inflation before politics pushes back. The math that says structural forces, demographics, geopolitics, climate, don't show up in next month's CPI print, but they can steer the next decade. On this channel, we look at history not as a museum piece but as a pattern library. The 1970s stagflation story isn't about scaring you into thinking we're doomed to repeat every step. It's about recognizing which parts of that old playbook are being dusted off today, and which parts we still have the power to change. If this made you see today's inflation in a different light, let me know in the comments. Do you think we're leaving the 1970s behind, or are we still living with its shadow in our paychecks and savings accounts? And if you want more deep dives like this, connecting the financial ghosts of the past to the headlines of right now, hit like, subscribe to History and Today, and turn on notifications so you don't miss the next story.